One of the most important distinctions that you and I can make as investors is what is really the difference between growth investing and investing, and essentially what's the difference between a growth stock and a value stock. And a lot of people don't really have a good answer, or they come out with statements, well, low PE ratio stock is a value, dividend is a value stock, or growth stock is a high valuation, low or no dividend. These are symptoms of growth and value investing, of growth stocks and value stocks, but they don't really tell you what this means. And since you hear so much about growth investing and value investing, in which is a better way, it's really an opinion which is better. I think you need to understand it. And I want to teach you this in this stream. So stick around with me. And if you like what you see, please give us a thumbs up, whatever platform you're watching on. If you have any questions, ask me in the comments. I love hearing from you. And even if you're watching this in the replay, well after the live stream, it's still there, and I will still see your questions in the comments. And of course, if you have any words of wisdom or experiences you want to share in the comments, certainly go ahead and do that. I would always appreciate it. So let's roll the intro, and here we go. All right, thank you for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. I do this almost every weeknight, and it's always about perspective. It's not just another, market rundown. What did the market do? What did the indexes do? Probably you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. But I want to add perspective so that you could be better with your financial decisions. That's what this is all about. So let's talk about growth versus value. First, we'll talk about value. Okay. Well, let's this is it's like it's not that I have writer's block, it's I have too much in my mind. Here we go. You have the economy growing at a certain long-term rate, which is typically around 2%. Sometimes the economy grows quicker. We recently had a 5% plus quarter. But aside from that, a value stock is typically a company whose growth, earnings, and revenues is at or below the growth of the economy. So if a company is growing, let's say, 1 or 2% or 3% a year, if they can grow that much, it's probably a stock that has not performed exceptionally well. It's probably a low PE ratio. PE ratio means the price of a stock divided by its reported earnings, price over earnings. And it's a very popular metric that investors use to value a stock. I personally do not pray at the altar of PE ratios. I don't think they're that meaningful. I certainly believe, in my experience, because this is the reality, low PE ratio stocks and that are often trading at or near their year low are far from bargains. In my experience, these are value traps. These are companies that are troubled, that are probably going to have economic financial problems. They're probably on the way lower. And often these companies go into negative earnings and have a negative PE ratio after a while. I'll give you an example in a moment. And then there's companies. Okay, well, let's go back to that valuation. Value stocks often have a dividend. Doesn't mean a company or a stock, we're talking about the stocks of companies. It doesn't mean that if a stock has a dividend, that it's somehow a superior asset class. I know we're conditioned to think like that. Oh, if a stock pays a dividend, that's wonderful. That's so many pluses, so many positives to own a stock that pays a dividend. And I could go through all the stats that the stocks with big dividends have not done so great. I could look at the exchange traded funds that track stocks that have lower dividends but grow their dividends, have vastly outperformed over time companies with higher but steady dividends, companies that don't grow their dividends. So let's get into this a little bit because you are hearing about this so much. I don't mean to bow out of the screen, but my furniture distributor sent us chairs, only a few months old, and as time goes on, the chair keeps sinking like the hydraulic thing in the chair is not working, annoying as hell. So I keep going lower and lower. A value stock that has a low P ratio and a dividend is not a value stock because of those two things. A value stock is characterized as such because its earnings are no longer keeping up with the pace of economic growth, of GDP. Revenues as well. I mean, there are plenty of companies that don't have earnings, but they have revenues that are growing at a rapid clip. So let's talk earnings and revenues as one at the moment, and let's say they are not growing as quickly as the economy, or maybe as much as the economy. That's about it. But probably, how many companies grow exactly to the GDP of the U.S.? So companies that are growing at or lower than GDP, the stocks are lower because of that. And maybe they will do everything they can to invest in technology and wring out every penny of expenses that they can, and they'll do their best to pay a dividend and grow the dividend. But a lot of times a stock, let's say at 100, that's paying $1 a share dividend, it's 1%. Now, if that stock goes to 20, all of a sudden that dividend becomes 5%. So 5% dividend yield on a $20 stock that's maybe trading at 10 times earnings. Well, you could say that's a value stock, low PE dividend, and the stock is only down from 100. Maybe it's trading around its year low. We could debate that whether a particular stock is a value or not. But if a stock is a value, meaning its growth is slowed and it's really, it's able to make enough money to pay the dividend, but not able to really grow earnings to any extent, and it can't grow the dividend to any extent, it can't raise the dividend, it's probably a value trap. And unless there's some kind of catalyst to reignite the growth of the company, a new technology patent, a new, drug discovery, something special, the stock will probably remain cheap for a reason and stay that way. And eventually, as the company faces obsolescence, which is why its earnings and revenues aren't growing, eventually the stock will go lower and lower. And then the PE ratio goes lower, and then eventually goes higher, because as their earnings disappear, maybe it goes from 20 to 10, but now it's making a penny in earnings. So now it's 1,000 times earnings. Doesn't make it a growth stock. Certainly not a value stock from 20 to 10. Where's the value in that? And then eventually they cut their dividend, because now they either pay their dividend or they retain that money to stay in business. So dividend cuts are often more common with value, quote unquote, value stocks than growth stocks. So we'll look at a couple of examples in just a moment. Okay. So let's take a look at what a growth stock is. A growth stock is a company, the underlying company, whose growth in revenues and earnings, either one or the other or both, exceed GDP, that the growth rate of the U.S. economy, gross domestic product. And those are considered growth stocks because they're growing faster than GDP. And as a result, they often have a higher PE ratio, smaller, below average dividends compared to the overall S&P 500, and they often have a higher metric, higher valuation by investors. So they have a higher PE ratio, and they're often up. And once in a while they dip, but they typically recover because investors see the stock get cheaper, and they want that growth. So if a stock is a value stock and you hear about a money manager saying, we're all about value, we are starting a new value fund, I don't get excited about it. And I certainly don't, again, I don't get excited about a low PE ratio. People used to, that was a common thing. Someone would call me and ask me about a stock and they would say, well, the PE is low, the dividend is high. You look at the chart, it looks like it's bottomed out. It's been trading flat for a long time. That looks like a stock I want to own. And then somebody will say, oh, that's a Warren Buffett stock. No. Warren Buffett, because of Charlie Munger, changed the way he invested. And what he did is he bought growth stocks in which he thought they have a reasonable chance of remaining growth stocks for many years into the future. Okay, that's what he bought. As my dad once said when he was trimming some trees, he said, dead wood doesn't grow. Take that as an example. Okay, that was a long time ago. So another way to look at this is growth stocks typically have little dividend payment or no dividend payment, but they typically raise their dividend over time. That's why dividend appreciation funds typically do better than high yield dividend funds over time, because companies that have consistently shown they could grow their dividend are doing so because their earnings and revenues are going up. And companies with a fat dividend but never raise the dividend, it's because they don't have earnings and revenue growth to actually raise the dividend. So that's the difference between growth and value, and I want to give you a couple of examples. Pat myself in the corner. Here's Ford Motor. Now, we could take a look at a chart here. Let me make this a little bigger so you can see this. Okay, here's Ford. Here's a one-day chart, but let's take a look at a 5-year chart. Stock was 23 and change at one time. I remember many years ago, the stock was in the 30s. And I remember I worked with a guy when Ford was paying, this is like 2000, 2001. I remember Ford was paying like 15% dividend yield. And there was another financial advisor, and he was like, Ford's paying 15%. What's wrong with that? Talking to his clients about buying Ford. I remember saying to him, that just means you're going to cut the dividend. It's a very risky proposition. Ford has never regained its glory as a stock. It's always been a one-day story. One day, Ford will catch up. One day, Ford will do something. In the meantime, the dividend is nice. It's 5.6% dividend yield, but it's down almost 9% for the year, and the P ratio is a little under 7. Does that mean it's a value stock? No. By the way, they have a ton of debt. Their debt to equity ratio is 322%. That is pretty darn high. And then you take a look at Tesla. Okay, Tesla, even though it's down from its highs, well, it's not down much from its highs. It was up to 350 one time, but $238. Look at this chart, though. It's the opposite of Ford, where Ford had the big hump over here where this is, where the gray boxes, and down. It's the opposite of Tesla. And Tesla has a PE ratio of 77 and has no dividend. And their debt to equity ratio is only 8%. So which one do you think is really the growth stock and which is the value stock? And this is why I'm not such a crazy guy over value investing, but that's one example where would have been a better place to be. And then you take a look at another high PE ratio stock. Let's take a look at NVIDIA. NVIDIA is $1 trillion market cap. I'm sorry, $1.15 trillion. They only pay a 0.03% dividend yield, and the PE on that is 61. Why? Because their net margin is 42%, gross margin 69%, because it's a growth company. And once in a while, you could troll in the value arena. And once in a while, you could troll in the value stock arena and maybe find a stock that truly is undervalued because you feel the rest of Wall Street is undervaluing the company in some way. Maybe you think the company's assets are worth more than the price of the stock. You see something on the horizon that would make the company's earnings and revenues go up. That is possible that a value stock or a down and out stock becomes a growth stock again. And an example of that is a company that again surpassed the $3 trillion market cap is Apple. People forget that twice in Apple's history, the company was close to going out of business. And that was for a long time considered a value stock until it became a growth stock again when it came out with the iPod, iPhone, and every other wonderful product and service that they offer. So that's the difference between growth and value. Value below GDP, value stocks typically have seen their best days are behind them. When growth stocks are in their best days or their best days could continue into the future or maybe even get better. Thank you so much for watching. I hope this helps explain what happened. Oh, you know what? Before I thank you, there's a few other things that impact this. I wish I'd said this before. Interest rates. When interest rates go up and you see yields on bonds go up, it means companies with little to no earnings, little to no dividend become more valuable because they have less competition. But when you see interest rates go up and you're getting more interest in bonds, for example, people start to say, well, that's worth something, and it makes expected future earnings worth a little bit less. So rising rates typically hurts the valuation of growth stocks, and growth stocks could go down. But it also hurts the value of value stocks, because when value stocks, companies that are value, they have to often borrow. They have more debt. Not in all cases, but as a typical category, they typically have more debt. So their borrowing costs go up, which hurts their earnings. It hurts their ability to be innovative. It hurts their ability to reinvest into research and development. And it also makes their dividends worth less. So a 3% dividend yield when interest rates are zero looks pretty good. But when interest rates are 5%, 3% dividend yield doesn't look so good, especially from a company without growth to grow that dividend yield. You know, the thing about dividends is people expect them to keep up or exceed inflation. That's why dividend grower companies perform better. But dividend companies with big dividends, but whose dividends remain flat, they're not valued as richly as dividend growers because investors expect the negative effects of inflation to eventually wear away at that nice, fat, juicy dividend. So that's the story. Let's keep that in mind. Thank you so much for watching. I'll talk to you tomorrow. Thank you.